So in this question, we're focused on analytical procedures. Now, we don't know what type of engagement, but ultimately it doesn't matter because when it comes to performing analytical procedures, the first thing we need to do, which is exactly what this question is focused on, is develop an expectation of a balance or ratio by using relationships that are expected to exist. So let me give you an example because this is very important for you to understand what it truly means to perform analytical procedures. So in our example, let's say that we are looking at bad debt expense. So the audit team would ask themselves, okay, what's the driver of bad debt expense? Well, the only way they can incur bad debt expense is when they sell on credit to a customer. So if we looked at our historical financial statements, we might say, okay, in the past, bad debt expense has represented 5% of credit sales during a period, right? That's our expected relationship or ratio here. So that's the first thing we did. And then our next step would be to actually perform the analytical procedure. So we would take the current period revenue, multiply it by this 5% expected bad debt, and that would give us our expected bad debt expense. Then we would compare that to what the company has actually recorded in their financial statements. And we would say, okay, this either makes sense or it doesn't. And if it doesn't make sense, then we need to investigate. Right? So that is a perfect example of a simple analytical procedure. But what's the first thing we did, which is what this question is asking on? We developed our expectation of what the balance should be. We have to do that before we can actually do or perform the analytical comparison. Without that expectation, it's just a worthless procedure, right? So the correct answer is going to be develop an expectation of a balance or ratio by using relationships that are expected to exist. Now for these other options, they are something we would be performing with an analytical procedure, but not until we develop that expectation. So where it says determine whether the difference between the expectation and the recorded amount is reasonable, well, yes, we certainly would perform that. We just talked about that, but that only comes after we develop an expectation. Right? So that option is incorrect. This next one says investigate and evaluate significant differences from the expectation. Again, that is very similar to the one we just talked about. That comes after we've developed an expectation, right? So we have our results. Does this make sense or does it not? If it doesn't make sense, we need to investigate. That's all that means, right? So that option's incorrect as well. So this last one, very similar to our other two incorrect options. It says compare the client's recorded balance or ratio with the expectation. That comes after we develop an expectation, right? We have to develop this expectation to get our expected balance, and then we compare that with the actual recorded balance, right? So that's why that option's incorrect. Again, when it comes to analytical procedures, it's develop an expectation and then compare our expectation to the actual balance and investigate any differences as needed. That's as simple as it can be for analytical procedures. But if you got this one wrong, you probably did not identify that word first. What is the first thing we do when we apply analytical procedures? So now you can see how important it is to focus on little keywords and phrases for these audit multiple questions. Otherwise, you're just going to skip over those details. You're going to find an answer that makes sense because they all can make sense, and you're going to get it wrong, right? So very important to read the sentence in extreme detail.